So another trade management video. A lot of students have been asking me, why not discuss trade management? Also, a lot of students have been asking me, why not discuss more and more weekly time frame charts? So that is exactly what I'm doing. In the previous video, I spoke about some of the basics. Some of the students were not even clear about chart layout. How will they trade? Before that video, we started with trade management and we looked at the stock of BHEL. Here we are looking at persistent systems weekly time frame chart. This is a very old chart. So as per SEBI regulations, we are allowed to discuss this chart. So this is 14 December 2020. You see this Corona crash. This was March 2020. After Corona, the stock market made a huge rally, and some of the stocks in that rally also made huge rallies. Okay, this is one of them. Have a look at this base. The first thing you count inside the base is the number of red bars. So where does the base start? See, that's a cup. Okay, this was marked as a cup with handle on Market Smith. I don't know why they did that. And they marked the high of this candle. Yeah, the high of this candle, 672. They marked that as a pivot point. I don't know why they did that because I don't see any handle here. Okay. So I would call it a cup, and it was base number two. And at the closing of this week, the relative strength of the stock was 86. So in general, if you notice the pattern or trend in the stocks that I am discussing in this positional stock trading video series, stick to stocks with a relative strength of 80 or more. Although our filter says 70 or more, majority of the winners, they come in the category of 80 or more. In fact, if you read William O'Neill's book, in which he talks about the L in CanSlim, the L chapter where he talks about leaders versus laggards, he says that the average relative strength of all the winners of the past 100 years was 87. What does that mean? So it means, so for example, if you have three stocks in your portfolio right now, look at the relative strength of those stocks. Let's say one has a relative strength of 92, another has a relative strength of 90, and the third one has a relative strength of 88. So 88 plus 90 plus 92, all of that divided by 3. What's the average relative strength is 90, right? Which is more than 87. So that portfolio is likely to do well. That's what I'm trying to say here. Okay. So the average relative strength of all the winners of the past was 87. This is clearly mentioned in the book written by William O'Neill, the L chapter in CanSlim. Here, the relative strength was 86, which is fair enough for us. Where does the base start? The base starts not from this bar. The high of this bar is 692.95. The high of this bar is 695.30. So 695.30 becomes our the high of the base, which is the pivot point. Okay. How many red candles in the base? 1, 2, 3, 4, 5, 6. Out of 6, how many are low volume? 1, 2, 3, 4, 5. 5 are low volume, correct? Only this one, the first bar, is high volume. Is that a weak closing bar? No, because the midpoint, the closing is near or above the midpoint approximately. Okay. So which means the remaining 5 red bars, they are already in our favor because they are low volume. And the one bar, red bar, which shows high volume, that too is in our favor because the closing is not weak. So which means all the red bars in this base are in our favor. Okay. What do we want to look at? We want to have low volume on a red bar. Okay, that's our criteria to determine whether institutions are selling or not. We want low volume on red bar. That indicates retail selling, not institutional selling. If at all there is a high volume on red bar, then at least we need strong closing, which means in that week, the stock must close above its midpoint. So that indicates a bounce of the low in that particular week. I think by now If you have been watching this video series since part 1, you have probably become very good at understanding a base. Okay. And I congratulate you for that because you have put a lot of effort to study this video series. Now you know what minute details to look for inside the base. What else have I taught you? Did I not teach you the uh, tight closings and tight spreads inside the base? Look at these tight spreads, the distance between high and low. Look at these tight closings, 1, 2, 3, 1, 2. Look at these tight closings. Look at these 3 weeks tight closings, although these two bars are before the base, but look at the tight closings. The reason why I am drawing your attention to such minute details inside the base is because when you see the rally, you will understand this stock rallied like 180%, maybe 200% when I moved the price forward. You will understand how powerful this rally was. Okay, so it is very important skill for you to determine the quality of the base. Once you understand the quality of the base, you will be able to confidently take the trade, and not just take the trade, but hold on to the stock, irrespective of market conditions and fundamental weakness, temporary, quarterly, all of that. Okay. So that is why I am drawing your attention to the minute details. It is base number 2. It is early stage, relative strength 86, tight closings, tight spreads, all the red bars in our favor because most of them are low volume. It's a nicely formed cup pattern. Okay. Low volume all throughout the base, which indicates retail selling, not institutional selling. Very good technical setup, extremely good technical setup. Okay. Now let us move forward because this is a trade management video. So in the orange trading system, trade management comes last. You start with filtering, shortlisting, and stock selection with the help of liquidity, comparative, technical, fundamental, and market analysis. I assume you have done all of that on this stock. Let us assume we have done all of that on this stock. And now we have decided that we are going to take a 10% position size in this stock once it breaks the pivot on high volume. Okay, 10% position size. Then we will execute the trade as it is breaking the pivot on high volume. Then we will manage the risk by keeping an 8% stop loss below our average execution price, which is given to us by our broker after we have executed the trade, and the average execution price must lie inside that blue pivot range. Okay. And then the last step comes trade management, which is what we are going to discuss here. What is our trade management plan? Trade management plan is very simple. We will buy 10%. We will take a 10% position size. Once it starts to go up, when it goes into the green selling zone, we will sell one third of our total number of shares that we bought. We will keep the remaining two third as long as the price remains above the 10-week simple moving average, which is this blue line. The moment it closes, once it starts going up, the moment it closes below that 10-week simple moving average, we will sell another one third. If that closing comes on low volume, we will sell one third. If that closing comes on high volume, we will sell all of our shares. After the second sale, we allow the one third to fluctuate as it is because now although the price is below the 10-week simple moving average, it is way beyond our buy point. So we allow the remaining one third to fluctuate. Supposing it bounces back and goes again above the 10-week simple moving average, then we wait for another close below the 10-week simple moving average. This time it could be low volume close, high volume close. We don't care. If it closes below the 10-week simple moving average, we are selling the remaining position. Okay. Let's go in with this plan and see what happens in this stock. You will be amazed to see how little you have to do to earn profits on a weekly time frame chart. Okay, if you buy correctly and if you buy the right kind of stocks which are fundamentally strong. Fundamentally strong means which meet at least 7 out of 12 of our fundamental criteria. Okay, so Warren Buffett has once said that the market does not reward you for activity, the market rewards you for being right. So all of this short-term trading, intraday trading, and all of that is really not required if you buy a good stock at a proper pivot point, coming out of a base on high volume and just sticking to the winner. Okay, just sticking to the stock. You will understand that when you see the price movement of this stock. Okay, I want you to do this on your trading view chart. Okay, once you start moving the price forward, you will understand that as long as the price remains above the 10-week simple moving average, you really don't have to do anything. Okay, the simplest tool for trade management on a weekly time frame chart is the 10-week simple moving average. There are multiple rules given in William O'Neill's book. uh, as far as selling is concerned, there are two chapters on selling. Okay, there are so many rules given in the book that I myself got so confused. How am I going to remember all these rules? So I just gave up and I just created my own rules. And one of those rules is this. It's extremely simple. You just follow the moving average. That's it. One third, one third, one third. Okay. And every time you sell the first one third, make sure you move your stop loss to break even so that you don't lose money on the remaining two third. Very, very simple. Psychologically, it's a very simple trade management principle. Okay. Let's draw the pivot point, pivot range. So this is 695.30. Okay. So let's do our drill. 695.30. I will now take out my legendary calculator. This is my legendary calculator. This video might be long. I will have some water. Okay. So 695.30 multiplied by 1.05, which is 730. So I will not write two decimals, 730. Okay. And blue color. That's it. Now let's draw the stop loss. Red color. 695.30 multiplied by 0.92, which is 639. And then 695.30 multiplied by 0.95, which is 660. Very simple. Stop loss range is established. Then selling range 695.30 multiplied by 1.2, 834. Then 695.30 multiplied by 1.25, 869. See how much time it takes? 1 minute. It takes just 1 minute to do all of this. Very simple. Why do you need automation and things like that and all of those things? It's very simple. Use this Casio calculator, the calculator that your local Kirana guy uses. Very, very simple. All we need is a Kirana calculator. Okay. Next. So now the price is between the pivot point and the 10-week simple moving average. Wonderful base. I have told you the nuances of the base. Early stage, which means we can hold on to the stock. Now you know the plan. Okay. Let's execute the trade. So I will click here. Monday, nothing. Tuesday, yes. Tuesday, we have a chance to buy the stock. Now, I don't know how the Tuesday played out because it breached the uh, stop loss range. But I'm assuming that it first breached the stop loss range and then it went up. Okay, I'm just assuming that. I have not checked the daily chart. You can check it later. But I'm assuming it first breached. Let me go back to this. So this is Monday. Yeah, so Monday itself, the stock was trading in that red color. So I cannot determine whether Monday or Tuesday the stock was trading in that red zone. So when the stock was actually trading in the red zone, you are not, you hadn't bought the stock yet. Okay. Tuesday, I'm assuming the stock first went down and then started to bounce. If it had gone up and then came down and then again went up, that would have been a crazy price movement. Just go and check the daily time frame chart just to confirm. But let's go in with the assumption that after Monday, it first went down and then it started to go up. Okay. And then it entered the blue zone. Okay. Once it entered the blue zone, this was a buy signal to buy at least 50% of your position size. So if we are planning to take a 10% position, we will have to buy at least 5% there as it breaches the pivot, because look at the volume. The volume is already more than half the average weekly volume, and that too on a Tuesday. Okay. So clearly this is going to be a high volume breakout week. We know that just by the volume coming from Monday and Tuesday. Wednesday continues to go up, and the volume has broken the average weekly volume, which means you got an opportunity to buy the remaining 30 and the 20%. So you bought 50%, which means you put 5% of your portfolio in the stock on Tuesday, maybe late in afternoon when the stock entered the blue zone. It must have probably first breached that stop loss range, then bounced back from there, entered the blue zone on a Tuesday late afternoon. So you bought 5% on a Tuesday late afternoon. On Wednesday, you saw the volume coming in, breaching the weekly volume. So you bought 3% on a Wednesday, maybe early morning, early afternoon, and then you bought another 2% late afternoon. Okay. And the stock closed inside that blue zone. Okay. So now we have taken 10% position size in this stock, still have Thursday and Friday remaining. So Thursday and Friday. So Thursday. So there were only 4 clicks here. So maybe during this week there was some public holiday. I don't know. Yeah, it's 21 December. So maybe Christmas came during that period. And then we go to 28th of December. So probably Christmas Day was not a trading day, but we managed to get 10% into this stock. Now, what is our plan? Our plan is very simple. If the stock goes into the green zone, we'll sell 1/3. So let's move it forward. Okay. Yeah. So in this week, you get an opportunity to sell. How many weeks? One, two, three. After you buy in the third week, you are getting an opportunity to sell. Here we don't look at volume. As long as the stock enters this zone, we get an opportunity to sell. So on that 1/3, we make roughly, so let's say our average selling price is somewhere in the middle here, and our average buying price is somewhere in the middle. Average selling price is somewhere here. So 19% roughly. Okay. So on the first 1/3, we make 19% return. So we have sold 3.33% out of our 10%. Okay. What is remaining? 6.67%. We will keep those shares and we will move our stop loss to break even. Okay. Break even means somewhere here. Let's see what happens next. See, the stock tries to come near our break even. So the remaining 2/3 uh, position which we held on to, that was in danger. But if you closely look at volume, you will notice that this is not institutional selling. This is retail selling. And the stock never entered the blue zone. Where is our average execution price? Our average execution price is inside the blue zone, because we bought when the price was trading inside that blue zone. So since none of these two candles entered the blue zone, okay, we still held on to that 6.67% position size. On the first tranche that we have sold, we have made 19%. Let's see what we make on the second tranche. Now we are waiting for a close below the blue line. Okay. Let's see when does it close. See, it touches here but doesn't close. Okay. So I'm clicking this. I'm moving the price forward very fast. I have to click 5 times to get 1 bar. Okay. Because there are 5 days in a particular week. So I'm clicking aggressively here just to move the price forward. I'm just waiting for the price to close below the. Look at the amount of gain that you're earning from your original buy point. This is called a rally. Okay. This is called inactivity. Remember what Warren Buffett said? The market does not reward you for activity. The market rewards you for being right. Okay. You were right by buying this stock at the right pivot point. And look what happened. The remaining 2/3 is just going up and up and up, not stopping at all. It's a crazy run, right? Doesn't stop at all. Absolutely crazy run. Okay, see, this is the close below this is the first candle which has closed below the blue line after the breakout happened here. Look at all these bars. Tell me one bar which has closed below the blue line. Not this one, it bounced. Not this one, it also bounced. Not this one, it also bounced. Okay, only three bars touched. So this is the close. So this is the selling, that too coming on low volume, which means there might be still some juice left into the stock. So let's calculate. We'll sell one third here again. So let's calculate. This is the power of weekly chart, and this is the power of doing nothing. Okay, this is 176%. So 176% return plus 19. That's 195% return. Now we still have the remaining one third. Okay. Let's move the price forward. Let's wait for another close below the 10-week simple moving average. Yes. This bar closed below the 10-week simple moving average, that too on high volume. So that's a clear sell sign. So what do we make there? So that's 200% return. Okay. So on the remaining one third, you make 200% return. Here you had made how much? 176 roughly. Okay. So let's calculate. I'll keep it here. So 3.33% first position, you made how much? 19%. Then 3.33% second position, you made how much? 176%. Then 3.33% into 200%. That's what you did, right? So 3.33% multiplied by 19% plus 176% plus 200%. Okay. This is 3.33% multiplied by 19 plus 176 plus 200. That's 395% return. What is 3% of 3.33% of 395? 3.33 divided by 100 multiplied by 395. 13.15%. So 13.15%. So this is the uh, amount of return that you made on a portfolio level from one stock. Imagine finding five stocks like this in a single year. Okay. So how much this run was? So from here till the end, okay, this was January 2022. This was December 2020. So from December 2020 till December 2021, that's 1 year plus another 1 month. So 11 months. You were in the stock for 11 months. Okay. At least you had some position in the stock for 11 total months. 11 months, you are earning, it's like, no, sorry, not 11 months, 12 plus 1, 13 months. You are in the stock for 13 months. 13 months you are in a stock, and one stock gives you 13.15% return. So it's like almost in 1 year you made that. Imagine finding five stocks like this in 1 year, just five stocks in 1 year, where you make this much money. 13.15, like 13 multiplied by 5, that's 65% return from five stocks on a portfolio level, not position size level, on a portfolio level. Out of that 65, you can deduct uh, all the trades where you experienced stop loss. You will not take only five trades in a year, right? You will take a lot of trades in the year, maybe 25 trades or 40, 50 trades. Okay. Out of those, five have given you maybe 65% return. And generally, that is what happens. Very few, like 20% of your stocks give you 80% of the result, the Pareto principle. So this is like making 131% return on a 10% position size. 10%, see, this is equal to what happened here. Yeah, 10% multiplied by 131%. Okay. So it's like you sold in three tranches, but it's like making 131% return on a 10% position size, so that it becomes 13.15%. Okay. I'm just telling you the equivalent what you are making. So see how powerful Warren Buffett's statement was. The market does not reward you for activity. The market rewards you for being right. What activity you did? You did only one, that is buying, then here selling one, two, three, four. Only four times you actually pressed the buy or sell button, correct? Only four times, right? Of course, here you bought 50%, 30%, 20%. So we can count that as 3 plus 4 plus 5 plus 6. Only six times you pressed the buy and the sell button. That's it. In 13 months on one stock, just one stock. That's the power of the 10-week simple moving average. I cannot give you a more simple trade management method than just tracking the 10-week simple moving average. Of course, you will go through a lot of emotions during these 13 months. You might think that the stock might collapse 20-25% in a single week, which does happen. But so what? We already had our plan, right? Before even we took the trade, we knew that we are going to put 10% of our portfolio in the stock. Before even we took the trade, we knew that we were going to sell one third when it enters the green zone. Before even we took the trade, we knew that we are going to sell when the price closes below the 10-week simple moving average on low volume. Before even we took the trade, we knew that we are going to sell the stock if it closes below the 10-week simple moving average on high volume, right? We knew all of that before even we entered the trade. That is called as a proper trade management plan. So much time has gone in this stock, but it gave you your patience pays off, right? This was the Corona rally, the rally that started after Corona. And this is called as a real rally. This is the reason why you need to learn the skill of identifying a high quality base. You need to learn the skill of proper trade execution in that 5% range. You need to learn the skill of trade management as the stock is going up. This is only one technique that I have taught you on trade. There are so many techniques available. Okay. Some of them which I discuss in my video course. In my video course, I don't talk about weekly charts. In my video course, I talk about the daily time frame chart, swing, and positional trading. The reason why I am more inclined towards positional trading on a daily time frame chart is because you get early entry, because you might see a VCP pattern getting completed on a proper daily time frame chart. So you might get 3-4% extra if you get that early entry. And on a daily time frame chart, you need to look at the intraday time frame for the volume. For weekly, this is more of a relaxed way of trading. So this kind of trading is ideal for those people who really don't have time to sit in front of the screen. See, all you have to do every day is to just open your TradingView application on your mobile phone and just ensure that the price remains above the 10-week simple moving average. Not even every day, just Friday, just once in a week, Friday, just 5 minutes before 3:30 when the market closes, just check, open the chart, open the weekly time frame chart, look at the bar. Is it closing below the 10-week simple moving average? If the answer is no, just move on, carry on with your life. 13 months will pass, nothing will happen, right? At least on this stock, nothing happened, right? So imagine watching a stock for 13 months without a single close below the 10-week simple moving average. That's a divine experience. That's a bliss kind of a, you will experience heaven in this life. Okay. So that's the power of positional trading. That's the power of inactivity. Now tell me, after looking at this chart, do you want to do intraday trading? That too, within intraday, do you want to trade options? Now tell me that. Okay. So think about what you want to do in your life in the long run. What kind of trading style is suitable for your personality? I know that a lot of traders love options and futures and short term intraday type of trading, this kind of trade is not for those people. Okay, this is for those people who have patience, who have a lot of patience. They can sit with a stock for an entire year as long as it remains above the 10-week simple moving average. So remember, in this video series, I'm giving you a basic trade management rule, which is the 10-week simple moving average. Okay, very, very simple trade management rule. I might discuss one or two more trade management rules in this series as we go along. Let's see. I'm looking for weekly time frame charts where I can properly explain the concept to you. Okay. I hope this video has been helpful. Use the 10-week simple moving average to your advantage. It is the most simplest tool that you will ever find on TradingView. It's just a moving average, right? It's very simple. Thank you so much.